Hey there, Knowledge Explorers. Welcome back to the deep dive. Okay, let's unpack this. Today, we're navigating something that can feel like, well, a bit of a dense financial jungle. Imagine you're making a big decision, right? Maybe thinking about lending to a startup or perhaps buying into a local business. You ask for their financials naturally. But here's the twist for a lot of businesses, especially the ones not trading publicly, those statements might not have that full-blown audit stamp. Instead, CPAs provide different, really specific levels of service. Our mission today is to get a clear handle on these levels, focusing on something called SSARS engagements. We want to make sense of what these services actually are, why they matter for you, and what they really tell you about a company's finances without, getting lost in all the jargon.
Absolutely. And what's really fascinating here, I think, is how these standards provide a framework for clarity and trust, even when you don't have a full audit. This is just vital knowledge for anyone looking at financial info from private companies. It gives you a much clearer lens.
Definitely. So let's lay the groundwork. What exactly are SSARS engagements? SSARS, that stands for Statements on Standards for Accounting and Review Services. Think of it as the rule book, the authority for unaudited financial statements for entities we call non-issuers. Now, non-issuers, what does that mean? Essentially, a private company, an entity whose securities are not registered with the SEC, not required to file reports with them, and has no pending registration statement. Basically, your typical private business. And these rules come from the AICPA's Accounting and Review Services Committee.
That's right. And the core purpose of SARS is to provide the standards for preparations, compilations, and reviews of financial statements for these non-issuers. It can even cover specific elements or accounts or pro forma information. It's pretty broad in that sense. But it's also crucial to know when SARS don't apply, like general accounting help, preparing a few adjusting entries, tax returns, consulting, bookkeeping. That's usually not covered. Also, if you're reviewing intra-financials for a non-issuer whose annual statements are audited, that falls under auditing standards, SAS, not SARS. And there's a bit of a judgment call here, too. If an accountant prepares, lots of adjusting or correcting entries, it could be seen as preparing financial statements. In that case, SARS would apply. Take some professional judgment.
Okay, this is where it gets really interesting. These three levels of service, they're the heart of SARS engagements. And they tell you a lot about the trust you can place in the numbers. It's like a ladder of assurance, maybe. Let's break down each one clearly so you can really see the differences.
It's exactly. Each level means different CPA involvement and critically different assurance. Okay, first rung, preparation. The goal here is simple. Prepare financial statements based on a specific reporting framework. The CPA does no audit or review work. None. So naturally, it provides no assurance. Zero. It's a non-attest service, meaning no CPA report is issued. And a key point, the accountant doesn't need to be independent, and they don't even determine if they are. Think of it as just organizing the client's data into statement format.
Just organizing, okay. No checking, no report. Got it.
Right. Now, moving up, we get compilation. Here, the objective is to present management's financial info in statement form, but again, without expressing any assurance, like preparation, no audit or review procedures are done. So, still no assurance.
Still no assurance.
But unlike preparation, a compilation is an attest engagement. Why? Because a CPA report is required.
Ah, okay, so there's a report involved now.
Exactly. And here's a nuance. Independence is still not required for a compilation. However, the accountant must determine if they are independent. If they find they are not independent, they have to state that lack of independence right there in their report.
Interesting. So they don't have to be independent, but they have to figure it out and tell you if they're not.
Precisely. It's a crucial distinction. Then, the highest level under SR's review. This is where we finally get some assurance. The objective is to express limited assurance.
Limited assurance. Sometimes called negative assurance.
That's right, negative assurance. It means the CPA is basically saying, based on my work, I'm not aware of any major changes needed for these statements to follow the framework. The work involves inquiry, asking management questions, and analytical procedures, looking for unusual trends or relationships in the numbers. It's not an audit, but it's more than compilation. Because they give a conclusion, a review is both an assurance and an attest engagement. And crucially, for a review, independence is required, no question.
Okay, that latter analogy really works. Preparation is just assembling. Compilation is assembling with a formal report, but no checking and maybe no independence. Review is doing some checking inquiries, analytics giving limited assurance, and requiring independence. So the quick takeaway, the pass key maybe. Attest means there's a report. Non-attest means no report. And assurance means you get an opinion, like in an audit, or a conclusion, which is the limited assurance from a review. No assurance means, well, no opinion or conclusion.
Exactly.
And what if an accountant does, say, a compilation and an audit for the same client?
Good question. Generally, you issue the report for the highest level of service provided. So in that case, the audit report covers everything.
Yeah.
You wouldn't issue both a compilation and an audit report for the same period.
Right, that makes sense. You wouldn't want to confuse people with a lower level report when a higher one exists. Okay, so we know the levels. But
Yeah.
who's actually doing what in these engagements? Who holds the responsibility?
Right, that's fundamental. Every SR's engagement involves three key parties. First, there's management, the responsible party. They really carry most of the weight. They have to pick the right accounting framework, prepare the statements fairly, design and maintain internal controls, prevent and detect fraud, comply with laws, make sure records are accurate and complete, and give the accountant access to everything, info, people, you name it.
Wow, that's a lot on management's plate.
It absolutely is. And if management isn't willing to accept these responsibilities, or if the accountant thinks the info is dodgy or doubts management's integrity, they shouldn't take the job, period.
Makes sense. So who's next?
Second, the accountant in public practice. They need enough industry and accounting knowledge to do the job right. They have ethical duties, follow the AICPA code, state rules, regulations. They need to use professional judgment and maintain quality control for the engagement.
Okay, knowledge and ethics.
And third, the intended users. These are the folks who will use the financial statements. Importantly, they're expected to understand the limits of the engagement. They know it's not an audit, for example, unless it is. Users could be management itself or banks, investors, whoever. But the accountant doesn't actually have a duty to figure out who all the specific users are.
Gotcha. And to make sure everyone understands their roles in the plan, you mentioned an agreement.
Yes, absolutely critical. All SR's engagements require a written agreement with management spelling out the terms. It's non-negotiable, sets expectations clearly.
Good. Avoids confusion later.
Definitely. And speaking of clarity, statements aren't always GAAP or IFRS. Sometimes companies use a special purpose framework.
Like tax basis or cash basis?
Exactly. Or maybe a contractual basis. If they do, there are specific disclosure requirements. They need to describe the framework, summarize policies, note big differences from GAAP, and add GAAP-like disclosures for similar items. And sometimes you see foreign frameworks. How you report depends on where the statements are going. If they're only for use outside the U.S., the accountant can use a SSARS report referencing that foreign basis, or even use a report based on that other country's compilation or review standards. But if those statements will be used in the U.S., even if they're on a foreign basis, the report has to follow SSARS, including those special purpose framework rules if needed.
Okay, so the distribution matters. And these engagements can cover a whole set of statements, or just one, right? Like just the balance sheet?
Yep, or specific periods too. Full set, single statement, specific elements.
Yeah.
SSARS covers it.
All right, now, here's where things can get a bit tricky. What if stuff happens after the work is done? After the report date, maybe even after the report is out there, financials aren't set in stone, right? New info can pop up. How does the accountant handle that? It sounds stressful.
It certainly can be. SSARS provides pretty clear, though complex, guidance. Let's break it down. First, you have subsequent events. These are things happening between the statement date and the report date that need adjustment or disclosure. If the accountant finds one, they need management to fix the statements. If management won't, it's treated like any other departure from the framework.
Okay, that's before the report is issued.
Right. Then there are subsequently discovered facts that come up after the report date, but before the report is actually released to the client or others. The accountant isn't required to keep looking after the report date, but if something does come to light in that window, well, they have to act. Discuss with management, see if statements need fixing, ask how management will handle it. If management revises, the accountant does more review work on the changes and either updates the report date or dual dates it.
Dual dating means showing both the original date and the revision date.
Exactly. But if management refuses to revise when the accountant thinks they should, the accountant has to modify their review report.
Okay, still somewhat manageable. But what about after the report is already out in the wild?
Yes. Subsequently discovered facts after the report release date. This is the trickiest. Generally, no obligation to keep inquiring, however. If the accountant learns about something material that existed at the report date, and people are likely relying on those statements, the accountant must take action.
Okay, so there is a responsibility even after the fact, if it's serious.
Yes. The first step is usually to advise the client to tell anyone relying on the statements about the new info and its impact. Pronto. discuss with management, figure out if revision is needed, see what management plans to do. If management revises, the accountant reviews the revision, updates or dual dates the report, making clear the new work was limited to that revision. And a critical step, the accountant has to judge if management's actions are quick and good enough to stop people from using the old, potentially misleading statements.
What if the accountant's conclusion changes based on the new info?
Then they have to add an emphasis of matter paragraph to their revised report, explaining the situation in the previous report date, what changed, why it changed.
And what should management do?
They might notify users the old statements are bad, issue revised ones quickly, or maybe disclose in the next period statements if those are coming out very soon. The goal is to stop reliance on bad info.
But what if the client just refuses to fix things, refuses to tell anyone?
That's the nuclear option, essentially. It's a serious breach. The accountant has to tell people high up in the company owners, the board. Then the accountant must take steps to prevent others from relying on their now compromised report. This could mean telling the client the report is withdrawn, notifying regulators as required, and crucially telling known users directly that the report shouldn't be relied on anymore.
Wow. They actually tell the users?
If necessary, yes. The notification has to be careful, factual, explaining the issue's effect. If the client blocks the investigation, the accountant might just have to say, look, info came up. If it's true, don't rely on our report. It's complex, high-stakes stuff. Professional judgment and, honestly, legal advice are usually essential here.
Absolutely. That's a huge responsibility, protecting the integrity of the information even after the job is technically done. Now, shifting gears slightly, but still on the serious side,
Huh?
what about the really big stuff, like fraud or breaking laws? What does the accountant do in a SARS engagement then?
Right. Even without an audit, there are responsibilities here too. If the accountant becomes aware that fraud or noncompliance might have occurred, they have to communicate that to an appropriate level of management.
Just might have occurred is enough to trigger communication.
Yes. Management then needs to figure out the impact on the financial statements. The accountant also considers how it affects their compilation or review report. If they believe the statements are materially misstated because of it, and management won't fix things or provide info, the accountant really should withdraw from the engagement.
Withdraw. Okay.
Now, this doesn't apply to totally minor, inconsequential stuff. No need to report every tiny issue. The communication can be verbal, but if it is, it needs to be documented. Written is often better. If the fraud involves, say, the owner withdrawing or getting legal advice, becomes even more likely.
And what about telling people outside the company?
That's a key point. Confidentiality rules generally prevent the accountant from disclosing this stuff outside the entity.
So they can't just call the authorities or the press?
Generally, no. There are very limited exceptions, like if required by law or regulation, responding to a successor accountant's questions, or if subpoenaed. But otherwise, it stays internal. It's a very important ethical line.
Okay, that confidentiality piece is huge. So, wrapping this up, it's clear that even without a full audit, DOS provides this really robust framework. It gives different levels of insight and assurance for these non-issuers. Understanding this helps you make sense of financials you might encounter, knowing what level of CPA involvement and comfort is behind them.
Exactly. It lets you read between the lines a bit better.
It's not about becoming an accountant, but just, understanding the playing field.
And that leads to a final thought for you, our listener.
Yeah.
Considering these different levels, preparation with no assurance, compilation with no assurance but a report, review with limited assurance, and knowing the heavy responsibilities on both management and the accountant, how might understanding these distinctions actually change how you evaluate a private company's financials? How does it affect your level of trust and the decisions you might make based on those statements? Something to chew on. The more you grasp the rules, the better you can interpret the financial story being told.
Great point. Thank you for joining us on this deep dive into SR's engagements. Until next time, keep digging for those nuggets of knowledge.